In this video, I interviewed David Hunter. David Hunter is a renowned macroeconomic forecaster. He believes gold is going to $10,000 by the end of the decade and silver going to $300. He believes we're headed towards a massive deflationary bust, the likes of which we haven't seen since the Great Depression, coming up here in 2021. And we talk a lot about the future. He believes we're headed towards very high inflation after this deflationary cycle. We talk about interest rates. We talk about the housing market. We talk about what he believes, in his forecasting opinions, the most profitable opportunities for investments are going to be over the next decade. So this is a fascinating interview. Make sure you hit the like button on this side and this side to send this out in the YouTube universe and more people see the video. And be sure to leave a comment down below and let me know what you think about it. And without further ado, here's renowned economic forecaster David Hunter talking about the future, gold, silver, profitable investment opportunities that could be available for you and I.
Thanks, Jake. Thanks for having me on.
So you have some pretty interesting forecast and predictions and some interesting themes, not only over the next 12 months, but over the next decade. And I'd love to get into the details of that to start. And before that, though, how, if any, has your views, predictions, themes, how has any of it changed going into 2020 now that we've seen such a bizarre climate with unemployment spiking and then the bailouts, and there's still a lot of people and businesses shut down? Has your views changed at all? And what are those views?
I'm sure. Certainly the shape of it has changed somewhat. Surprisingly, I, going back several years, have been talking about a coming global bust, a global deflationary bust, the first deflationary downturn, widespread deflationary downturn we have seen since the Great Depression. And that was with obviously no knowledge of a virus. And I actually, in my letter coming into this year, predicted that this would be the year the global bust would hit. People will tell you that I said that before. I thought it might hit earlier, but I had been very bullish for the last couple of years, talking about a melt up and followed by a global bust. And that was all way before COVID. Talking about it last summer and certainly my first letter this year. And then COVID hit, and I found out what the trigger was. My reasons for calling for a global bust was the massive debt on the system. We've got 250 trillion in debt and quadrillions in derivatives overlaying this system. And as I've said many times, everybody thinks about debt as leverage, but they don't realize or think about the fact that derivatives are another form of leverage. And so with leverage like we've never seen in the history of the world, at levels way beyond anything we've ever experienced before, it was pretty easy to say that whenever the next downturn hits, we're going to have a global bust. And so the fact that we're in this year is not a particular surprise to me. The trigger for it obviously was a big surprise, and what it's done in terms of the shutdown of the economy for several months, and the real hits to many industries, many that won't come back. All that obviously was not foreseen by me, but the ultimate movement in the market has been exactly as I called it. I mean, I shouldn't say exactly, because I didn't see March the way it hit. I thought we'd probably see the melt up before we saw anything like March. Obviously, the COVID hit and people panicked, and you had that sell-off. I could have easily, back in March, because I was looking for a bust and looking for a potential 80% bear market, I could have easily said this is the beginning of it. We didn't go up to the levels I thought in the melt up. We had our move in January, February, and that's just, it just fell short of my expectations. But I, circled around, re-looked at my work and looked at the markets and said, no, I think this is sort of a fake out. You did undercut some trend levels and things, but based on the sentiment at the time, which was extreme on the bear side, I said, I think the melt up's still going to happen. I think this just kind of sets up the sentiment for it. And I was calling for in March, at the bottom in March, I said we're going to 4,200, maybe 4,500 on the S&P out of this trough. So that's still my view. That's what I expect going forward into the election. And I think then we'll get hit with the second wave, which is, I tell people, I think we are in the bust. March was the beginning of the bust because of all the money thrown at it. We get a couple quarters of respite. And then I think 2021 becomes, second stage of that bust.
What does a deflationary bust look like?
Well, it doesn't look like anything we've experienced in the post-World War II era, I'll say that. I see a lot of people talk about deflation. I don't think most people who talk about deflation really understand at least this form of deflation, what it's going to look like. Our most recent experience in terms of deflation was in Japan, and they went through several years of deflation, but theirs was a deflation that was pretty modest, very modest, and where the economy was kind of still, getting through it. It wasn't what I think we're going to see here, which is much more extreme deflation. Could be as much as 3 to 5% deflation, as opposed to a fraction of a percent. And so everybody kind of looks as thinking it's relatively benign, not that much different from what we've been experiencing. I think it's going to be quite a bit different. Asset prices are obviously going to get hit hard. It's going to be fairly across the board that prices are going to be declining. It's markets, it's real estate, it's commodities. But it's also in other areas where businesses are going to really struggle because prices are just down. What we've done is we've spent 40 years battling the inflation spike we had in the early 80s, and the Fed and central banks around the world basically ratcheted down inflation over many cycles, and what's known obviously as disinflation. And what always happens at the end of such a big cycle, or what often happens, is they overshoot. And so I think we go from disinflation, which is good, to deflation, which is pretty rough to handle. The good news is I think what we're seeing this year in terms of the response from both the Fed, other central banks, and from the governments in terms of trying to deal with what COVID has done, sets us up. We're going to see even more of that next year. What I always say, people say, well, can't they head off a bust? And I said they could, but the history of the Fed is that they react rather than anticipate. So the money that we saw following the panic in March was a reaction. They didn't see that coming, and neither did I. I think the second stage of the bust, second wave of the bust, they won't be really anticipating that either. And I think, yes, we'll see money like we've never seen before next year, but it will be in response to the bust, not to head it off.
So do you see we kind of get through this phase where everybody thinks we're out of the clear, and this is the melt up you're speaking of, where everyone's like, oh man, things are going up and up and up, and then we kind of have that meeting of Main Street and Wall Street, and you're saying the response to that in a deflationary situation is, you said, money as we never seen. So you see even larger amounts of money printing, direct payments, or a form of universal basic income, like this type of money printing to pull us out of it?
Yeah, I see. I've been on record as saying we probably see the Fed balance sheet grow to 20 trillion.
Wow.
And that may be an underestimate. So, I mean, that sounds wild, but keep in mind, this is a global bust where I think we see double-digit negative GDP next year, and in an economy where the leverage is just huge. I think you're going to see a big financial crisis, bigger than anything we've had in history, bigger than 2008-9, and again, not just in the U.S. but global. So you're going to see some major bank failures, probably more centered in Europe and Asia than here because of what our banks responded in what they did in 2008-9 to respond to the Great Recession. So our banks are probably in better shape. They are in better shape than most of the large
How
world
long
banks.
does a situation like that last?
Well, surprisingly, I'm thinking it's pretty well contained to 2021. You would normally think, and I have, there are a lot of pundits out there that I say the difference between me and most of the gloom and doom pundits is that they're talking about this being the end of the super cycle, or they may not call it a super cycle, but where we're down for the count, and you get a reset of debt, you get a reset of current, of monetary system, et cetera. I don't believe that's what we're heading for this cycle. I think because of deflation, the central banks have virtually unlimited ability to respond. It's the timing that causes the bust. They don't respond fast enough with enough to avoid it. So they respond to the bust. But because of deflation and the lags to when that would turn into, and that money would turn into inflation, they virtually have unlimited ability to print. So, we've seen several trillion this year, which, prior to 2009, when we went into the Great Recession, we had a balance sheet that grew to 800 billion. And now we're at 7 trillion on our way to 20 trillion. So it just, it shows you somehow we've ramped up here. And I think we've ramped up because we're at the latter stages of a super cycle. As a result, they have unlimited ability to print, and the Treasury will have unlimited ability to issue debt because rates will be near zero. And that's the response you will get, because they'll be fighting the crisis right in front of them. It's not that they're ignoring or don't understand the risks of inflation with that kind of money creation. It's that, as I say, I forecast, I don't moralize. There's a lot of people out there that are, would like to do away with the Fed and do away with the ability to create money, or at least put it on a gold standard, that kind of thing. You can't do that when you're in the midst of a deflationary crisis, or else everything just collapses. The only thing that can turn this is that money creation. So yes, it will lead to problems down the road, but at least for 2021, they're going to have free ability to just print away, and that's what they'll do. Now, they printed a lot this year, and then they've kind of paused for a couple months. We've been at 7 trillion or a little over 7 trillion for a while. The Fed's not, everybody wants to say the Fed is anxious to do this. The Fed's reluctant. And that's, they're going to have to come back in here soon, I think.
Yeah. Yeah. That it's amazing that they haven't done a second round. There's still a lot of people with no money. I mean, I'm a lot. And even just talking to my liquor store guy across the street, he said they've seen sales go down. Just, he thinks people don't have as much money. But let me ask you, so then how do you see this play out? I mean, I'm much more of a layman, and I listen to that and I go, okay, so what are the consequences of that? Is that you try to get everyone out, you print zillions of dollars, you do direct deposits or form of UBI or whatever. Then I'm like, me as a 29-year-old, I'm like, oh my gosh, are the consequences of this that we kill the currency and go into hyperinflation after? What happens over the rest of the decade, or coming out of a deflationary situation like that? How do you see that unfolding?
Sure. Yeah, it ultimately is very inflationary. The lags to when you print money, the lags to when that impacts the economy, they're varied, but they're kind of in general 6 to 9 months. So, the money you printed in March and April is why we're going to see such a very strong third and fourth quarter. Third quarter could be 25 to 30% GDP annualized positive. So, it's coming out of a trough, so it doesn't mean we're out of the woods, but it's a big number. And fourth quarter won't be as big as that, but it'll be up. The lags to inflation, however, are much longer. And I would say they're at least 2 years. Coming out of deflation, they may even be longer in terms of any kind of meaningful inflation, but I would say probably around 2 years. So let's say you get that move to 20 trillion on the balance sheet next year. You're probably talking, some very gradual inflation by the end of 2022, 23, but it'll still be in the very low single digits. And by 2024, you begin seeing it ramping up. And by 2025, 6, it's double digits and on its way. And I'm guessing, obviously, I don't know the timing, but just to give you some sense that it's going to start gradually and then really, shoot up and go parabolic at the end. So my guess is that by the time we get to late 2020s, 2027, 8, you're going to be well into double digits on inflation. That means you're probably going to be well into double digits on interest rates. So that doesn't end well when you've got debt that's 250 trillion worldwide today. So I'm kind of mixing because I'm not talking about the U.S., but I think that could grow to 375, 400 trillion in this response to the bust. Mostly sovereign debt, not as much corporate, going forward. But that's already way beyond anything we can ever hope to repay. So there, let's say you get to 2026, 2027, and you have worldwide debt above $350 trillion, and inflation in double digits in the U.S. and high all around the world. It's just not an equation you can balance. It's not an equation that can be solved in any reasonable way, and it leads to, I think, ultimately, that super cycle collapse. So that's why I say the difference between me and the Peter Schiffs of the world, the gloom and doomers today, is I think they're one cycle too soon. I think there is one recovery cycle left before we get to the true collapse. And
what does that look like? I'm so enamored by the future, and even more so now that I have a daughter, because it's, there's an element of I'm not going to avoid something that's scary just because it's scary, which is what most people do. So I'm really, we'll get into your themes and your forecast for investments. You think gold's going to 10,000, silver to 300, but first, what does that look like at the end of a super cycle? So we've got these huge inflation coming potentially. You've got debt at these, mind-boggling numbers, and you say the end of a super cycle. What does that look like? Are you of the camp that eventually there's going to have to be a currency reset? What happens? What does this look like in your opinion?
Yeah, let me first define what I call super cycle. A super cycle is the full move, many mini cycles or economic cycles within it, but it's the move between two depressions. So the Great Depression was the last depression. I think the 2030s are setting up to be the next Great Depression. So it's that full move between them, from say 1940 through 2029, or something like that. So, a 90-year cycle, and I'm not doing it based on the years, but it tends to be a 70, 80, 90-year cycle. And so that's what I call the end of the super cycle. Frankly, what comes when, and I can say leading up to the top of that super cycle is what I think will be a full revisit of the inflation of the early 19 80s. So, we were at 20% inflation at the top in 1981. We were at 20% T-bills back then. We were at 15% long bond back in 1981. I actually think between the end of 2021 and the end of the decade, you will have a full retrace of the move down in both inflation and rates. So you'll be back at those highs. That's an amazing statement. And people may think I'm on drugs to say this, but it's not based on a personality or trying to be hyperbolic in terms of what I'm stating. It's just where we are in that end of the super cycle, and where we've, for the last several decades, sown the seeds through massive buildup of debt around the world, and now massive buildup of money. It will lead to what I'm describing in terms of the preceding of the next depression in terms of inflation and interest rates. What happens, let's say, in the late 2020s or beginning in the early 2030s? I really have to say it's anyone's guess. What I will say, it won't be good. It will be beyond anything I think we've ever seen, or certainly have seen in our lifetimes. I don't know how we resolve it. My fear is totalitarianism will reign.
Same. That's why I'm doing these interviews and stuff. So.
Yeah, I don't think it will be resets where you go merrily on your way. People can talk about a gold standard. You don't put a gold standard in at a point like this unless you want to live in caves in the next 5 years, because if you don't have that money, you're going to fast forward that to now. If you stop the presses now, we go down. Now, some might say, well, going down now is better than going down 8 years from now when you've built up these excess to much more. Yeah, I can't moralize. I'm predicting. I'm not necessarily saying this is right or wrong.
Right.
I'm just saying you're not going to have a U.S. government allow that. And there's no, the Austrians want to talk about doing away with the Fed and putting us on a gold standard, whatever. I wish we had done that 30, 40 years ago, and I certainly would have been a proponent of it then. Doing it now is just, you're asking for the doom first, and it's also just not realistic knowing our government. Our government will not choose to put 80% of the people out of work. Our government will not choose to put 50% of our population in out on streets. So they're going to do whatever they can to deal with the crisis right in front of them, and the crisis right in front of them is obviously an economic disaster. But once you get to that point down the road, 8 or 9 years, where it might even be sooner, it's somewhere late 2020s. When you get to that point where how do you fund your debt with double-digit interest rates? If we've got, debt to the levels we have now, and then that, doubles or is up 50%, there's no way we can barely fund it at 1%. How do we fund it at 12, 14, 15% and up? We won't be able to. I think the US government will lose access to the capital markets, I believe, before this all comes to that point. I mean, how do you pay your debt? And I'm jumping around a little bit, but I've often said, whenever we run over our, run deficits, or we have natural disasters and they declare disaster areas, et cetera, where does that money come from? Some of it's budgeted in, but when we get disasters that are beyond expectations, we just go and sell some more debt, right? And we have always been able to fund our needs. And, it's kind of kept us from having our standard of living drop substantially. But when you lose access to capital markets, which I think happens because people are going to, and the thing is, we're not in an isolated case. This is going to be, the rest of the world's going to be in trouble too.
Right.
And has most of the rest of the world has financial issues too in terms of excessive debt. But who's going to look at buying our debt? It's no longer going to be seen as the safest place in the world, because you can't. How are you going to finance that? I don't have the wherewithal to explain or understand how the equation works out, because at much higher interest rates, it will eat up so much of our.
So do you think interest rates are going to go up because they're going to lose control of them, or do you think they're going to try to make sure that people aren't burning wheelbarrows full of cash, so they're going to try to increase interest rates? I mean, they've said, we're going to keep them down. What do you think brings them up? Is it they lose control, or is it a policy measure?
Yeah, I've often said on Twitter, and I say to people, the Fed can control overnight money, and even there, they may not be able to control it when it gets into the inflationary cycle. But the markets control rates.
Right. Okay.
And when you get inflation, you get higher rates.
Okay.
When inflation will be coming because the economy's overheating. We're going to go from this deep trough this year and next into what I think will be the first inflationary recovery cycle that we've had since the 1970s. And I lived through the 70s. I came into the business in 73. And as a money manager, and so I lived through the inflation of the 70s, saw how it was generated. Our Fed chairman back there, G. William Miller, made a big mistake. He was raising rates gradually, thinking I'm tightening, but he was pouring money into the system to keep rates from rising faster because inflation was starting. And that money into the system is what led to the inflation that we saw in the late 70s, early 80s that Volcker had to tame. So it's the same thing here, that massive money is going to cause the inflation, and it's also going to cause rates to move up, first gradually, but then as we move through the decade, it's going to start ramping up ever higher.
What do you see? What do you see when I ask you? I said, how do we solve this? And you said, you were being candid and honest, and you said, my fear is I don't know how. So my fear is a authoritarian type of tyranny type of situation. I mean, do you see just that this gets bad and there's social unrest and they refuse to do a reset and create a better monetary system? So you think it just progresses worse and worse? I mean, what do you think in a summary before we get into gold?
Yeah, frankly, it's not so much that they choose anything. My problem is this collapse of the system. Basically, we're in a huge Ponzi scheme.
Right.
And this, once it starts unwinding, there's no way to stop it. Again, you can stop it now because they'll have unlimited ability to print money in the short term, in the next year. But when you have inflation and the same situation of an unwind beginning, you've tied the Fed's hands, because if they print more money, you just get more hyperinflation, right? Yeah. It's like pouring fuel on the California fires.
Right. It's
like pouring gasoline on those fires. That's how fast inflation would go from 20% to 40% in an eye blink. So what happens then is you've taken out of the difference between now and 8 or 10 years from now is now we have a Fed and a Treasury that have unlimited ability because there's no inflation, or there will be no inflation next year. When you get to the end of the decade and you've got a very unbalanced economy that's starting to unwind, and a very unbalanced capital system that's starting to unwind, the Fed's out of the ballgame. Their hands are tied because of inflation.
And then it's just kind of this mother nature that kind of just unfolds itself, and there's nothing anyone.
So then you get I call it collapse. I don't want to scare people, but I think it will be a steep unwind with high unemployment and huge asset depreciation, et cetera. And the only reason I say I don't know out of that is it's not by choice. You just don't know what's going to come out of that. Could it be something like after all the uh, pain and all the problems, could it be something like a reset with a gold standard on currency? It could be, but my guess is because there's not going to be support systems for this. I mean, if your government's bankrupt and there's no access to a capital market, how do you fund Medicare? How do you fund Social Security? How do you fund the welfare system?
And what about pensions? You used to work in the pension industry. That scares me a little bit with all these underweight pensions and so many people retiring.
Yeah, it's across the board. That's why I call it Ponzi scheme. We have unfunded liabilities in pension systems that just aren't going to ever be, and they're making choices in particularly in the public pension fund area of saying, well, our actuarial rates, rates are down at 1% or 2%, or our returns are far lower than 7 or 8% that we need to, meet our actuarial assumptions. So they're doing things like private equity.
Right.
In the short run, it may
riskier
seem
and
like
riskier.
you're staying away from the volatile stock market risks and things. I think private equity is going to be one of the biggest hits next year. Private equity, basically, the name was changed because leveraged buyout got a bad name back in the 80s. But private equity is just leveraged buyouts and leverage. It's the most leveraged part of the asset structure. So when this thing unwinds next year, I think private equity is going to be hit very hard. I mean, so is the stock market. So I don't know which is worse, but our public pension funds are heavily, and our endowments. A lot of the endowments have put a lot of money into private equity because they've been nice returns and more stability. That diversification is not going to save you next year. They're going to be hit just as hard.
So let's talk a little bit about your views on opportunities. You've talked at length about the metals. We can start there. You think ultimately we'll get to 10,000 and 300. Where do you see gold and silver going in the short term, and how do you see it unfolding?
Sure. Yeah, I would say I was a little premature. Back in 2016, we had a nice run in gold and silver. And, that was having come down from the highs in 2011. So I started talking then about, we've come out, we had basically a 5-year consolidation of the peak in 2011. So I thought 2016 was kind of the beginning of that. Well, it then over the course of the next 3 or 4 years kind of went up and down. It was more or less a wide sideways consolidation. And we came out of that, I guess, last year, and have furthered that certainly this year. I think we had a very long 8 or 9 year consolidation of that 2011 peak. And we are breaking out from that now in gold. I mean, gold's at new highs. And I think gold can probably run, I'm using 2,300 as a target for this year. It might be low. It could just easily be 2,500. And then, as you say, I think over the course of the next 5 to 7 years, I think it can run to 10,000 or higher. Silver lagged gold through this consolidation since 2011, but is starting to pick up speed, and the gold silver ratio is starting to move in favor of silver, which happens when you get a new bull market. And I think we've begun a big new bull leg in both gold and silver. My target for silver this year is 35. And then, as you say, I think it can get above 300 in the next 5 to 7 years with gold. So, and a lot of the what's going to propel it is inflation. Inflation in the next year, it's going to be a lot of money. Which will some of that money will find its way into the precious metals, and then the response to that money over time is going to be inflation and ever steeper inflation. And I think the gold mining stocks will be to the next cycle, meaning 2022 and beyond, what .com was to 1990s. So in other words, I think gold and silver and the mining companies that go with that will be at the very top of the performance scale in the next cycle.
Over the next decade. So let me ask you, when you have a situation, as you explained, and you know, you're running into this huge global debt and the government's in this incredible debt, and you're in a inflationary situation which could very easily get a lot worse than just, you know, 8-10%. I mean, who knows what'll happen, but certainly the prospects of it moving towards more on the scale of hyperinflation. For me as a young person, I listen to that and I go, well, what happens in a situation like that to later down the line, to miners and in overall stocks? I'm like, at the later stage of the decade, if you have that bad of a situation, do you only want physical gold and silver, and how does that all look in the latter part of the decade of owning an equity versus owning a metal? How do you see that all unfolding?
Yeah, it's a good question, because I do think, and it kind of begs a little bit of background on the equity markets. I think the secular bull market in equity started in 1982. I could make the case it started in 74 after the Nifty 50 bear market, but I choose 82 because that was the beginning of disinflation. And what went hand in hand was the run up in the stock market, you know, for the last last 38 years, and the drop in rates. So there's an inverse relationship there, because as rates go lower, PE multiples go higher. And what you're about to see here in next year, and probably in the next 6 months, is the low in rates. I think we get to negative rates. I think certainly the 10-year could get down to zero next year, first half of next year. But that whole drop from 15% long bond down to 1% long bond, let's say, has been the driving force for why the stock market went from where it did in 1982 to now many times higher. I think as much as I'm saying there's another cycle in the economy to go, I think the stock market is going to have a melt-up secular peak this year, and the likes of which won't be revisited in my lifetime for sure, and maybe not yours. So because rates will have reached zero in the first half of next year, and then start the move up towards double digits and higher, that whole reverse of the last 38 years, 39 years, will be the reverse in terms of PE multiples will be contracting. Parts of the economy will not do well because of inflation. Other parts will prosper. But overall, you can have a bull market coming out of a cyclical bull market coming out of 2021, out of the big bear market that we're going to have next year. But it doesn't mean you get anywhere back to the highs. So if, let's say, we get to 4,500 on the S&P this year, you could have a rally, and I'm calling for a potential of an 80% bear market next year, or from the peak, whether it starts late this year or early next. So that takes the S&P from 4,500 down below 1,000, or down to 1,000. You could have the S&P go from 1,000 and triple, or even quadruple, and you'd still fall short of the secular peak. So it doesn't mean stocks are done as an investment class or anything like that, but it does mean that from a secular standpoint, if you invest near the highs of this year, you may have a hard time seeing a positive return from that point. If you invest from the lows next year, you could have some very good returns. So there'll be plenty of stock opportunities coming out of that trough. But going back to the gold mining question, it's sort of the same thing, where at some point, yes, maybe the metals will keep going, whereas the higher interest rates is causing a drag effect or a huge headwind for the miners. Where's that crossover point? I'm not sure. I'm guessing it's probably out in 2026 or 7, where the miners will be the outperformer versus the metal until you get to that crossover point, and then from there, the physical will probably be your better bet. Paper gold may do fine until you really get to the collapse. I can't pretend to know exactly when. You got to be wary of it. I don't think we have to worry about paper, gold and silver in this cycle, meaning in the bust, because there's going to be so much money printed and stuff. You could have some hiccups like you saw in March. It wasn't an easy time for gold and silver investors in March, and you could have some of that again next year. But in terms of people talking about having to be in physical gold because paper is going to blow up, I don't think we're going to see that this cycle. Next cycle, at the end of the next cycle, very well could. I think.
So do you think that the market doesn't revisit its highs, but you think that your opinion is that mining stocks will continue to make new highs, whereas the rest of the stock market is not? Is that what you're saying?
Well, not exactly. I'm saying that if you're in index funds, you may see the high in those index funds this year and not revisit the high of those valuations even a decade from now. If you're in certain sectors of the market, that will also be true. In other sectors of the market going forward, which are the inflation beneficiaries and the industrial stocks that have lagged in this last several decades, those will be the leaders of the next cycle.
Okay,
that's another thing.
Understood.
Is that every cycle has different stock leadership.
Understood.
So in the 70s, it was industrial and commodity stocks. In the 80s, it was consumer growth stocks. In the 90s, it was tech and capital goods.
Okay.
In the 2000s, it was finance and housing. In the 2010, this decade, it's been social media and healthcare. In the decade or the cycle that follows the bust, I believe we're going to be back in a 1970s type environment where you're going to have industrial stocks, the old basic industry, the Caterpillars of the world, machinery, that kind of stuff, along with commodities, and particularly commodities. So it'll be both industrial commodities and precious metals, et cetera, because they're big beneficiaries of inflation. But it's also going to be a time, because of all the money printing around the world, you're going to have an overheated industrial economy. You're also going to have a lot of reshoring of capacity here and elsewhere. People are going to be pulling capacity out of China, and that's going to lead to a lot of new industrial demand to build factories, to build plants and equipment. So that's going to be part of the source of this inflation cycle. And also just the fact that you've printed money like you've never printed it before will lead to inflation. And as a result, the metals do very well. And the miners won't be the only stocks to do well. They'll be, like I said, the Caterpillars of the world, the machinery companies that do mining equipment, that kind of thing, will do well. But it'll be a lot of industrial. It'll be steel plants. It will be basic industry in general should do well. What won't do well will be the leaders of this cycle. Okay. So the growth stocks, because growth stocks are going to face higher interest rates, which means their multiples are going to be contracting. And so you're going to want to be in stocks. And I'll give you a kind of a general, rather than the specific sectors. You're going to want to be in stocks that have pricing power that will allow them to earn returns in spite of inflation, higher than inflation. And that's why commodities will do so well.
Understood. Okay, thank you for that distinction. I would that makes sense. You're saying we'll have growth stocks lag, in your opinion, and you'll see a new bubble form in commodities, industrials, and precious metals, and it makes perfect sense what you said. So if we've got gold go to 2,500, then 3,000, then 4,000, 5,000, you're going to have the financial statements looking better and better. So you think that the way to play this from a theme perspective is to take a step back and look back at the 70s and look at that commodities and gold and silver type of market. That's where you think, because the result of this is going to be, hey, we need to print a bunch of money. We need to get people jobs. We need to do factories. We need to rebuild roads, infrastructure. So there'll be this big industrial commodities demand. Gold and silver will see the beneficiary of the money printing. It'll give people jobs, and that's kind of how you see that.
Yeah, definitely. And I think, by the way, if you're in a global bust, money's nice, but money's not. Money leads to something else. You've got to have the demand created by something. A lot of that demand's going to be created by the fiscal side, meaning there's going to be a lot of government spending. And as you say, it'll be infrastructure oriented. So some of it will be the electric grid, some will be roads and bridges and sewers and airports, and some of it will be new plant and equipment, which we haven't seen in this country for decades. And again, this will be happening in other parts of the world too. We're not going to be unique to this. Right. It'll be, but that all then triggers demand for the underlying commodities and things. But I lost my train of thought in terms of
no, that's fascinating. That's because I want to end with where a lot of investors watching with where do you see the opportunity, and that makes a lot of sense. It makes a lot of sense to look back at the 70s and see, well, what are they going to do? They're going to print, build these factories, do all these types of things. So as a 29-year-old, I was never going to buy a house. It just seems like it makes a lot more sense to rent. I run my business out of my house. I can write it off and things like that. But then as we see all these things unfolding, I'm looking towards eventually getting a property with water. And I just think, I think we're headed towards a decade of more social unrest. And I just think that having a little bit of a sustainable farmland makes sense. And so I was curious how you see the housing market. I know you said you think there's going to be a deflationary bust. Do you think it'll recover, or do you think it'll stay lagging like growth stocks because of high interest rates? And then a lot of people in my generation can't afford a house, so eventually there'll be less demand. How do you see housing market real quick?
Yeah, it's a tricky call right now because you do have so many different dynamics playing out. You have people fleeing the cities, trying to get out of the high tax states, et cetera. Right. So, and the what's going on in terms of the unrest. So it's hard to predict. I tend to think that the bust will overwhelm that, or at least for a period of time, more than offset that demand. So that I think next year you're going to see a hit to housing. Could be 20% in general. I'm not sure, but probably not as bad as the subprime, situation in 2008 and 9, but still, a pretty good hit. And then you'll have, because rates will move up very gradually in the first year or two of the recovery, you'll probably have a period in there where people are coming back to work and they still have access to low mortgage rates. So you could have a bit of a bounce out of the bust for a year or two. But I would say through the decade, with mortgage rates moving into double digits from here, so you might get a 2% mortgage rate at the bottom next year. from 2% to go to 10 or 12 or 14% mortgage rates, there's no way that's going to allow real estate to move up, because most
Right.
people are buying houses on the basis of the monthly payment.
Right.
And that monthly payment, is hugely influenced by the rate you pay. So
Right.
I think, it's a bit of an inverse relationship between mortgage rates and the price of homes. Again, real estate's always local, so there'll be pockets. And I think farmland, frankly, will be one of the big winners, because I think farm commodities, agricultural commodities, will be part of this commodity boom in a big way, like all-time highs, much higher highs in, wheat, corn, soybeans, etc. So, I'm not talking about the next year or two, but over the course of the next decade. And one thing I didn't talk about that I just want to kind of put in there is that I think oil prices can get back to $10 maybe in the bust. You might retest them, towards the lows, not into negative territory like we did in March, but go back towards 10. I think could actually rally to 50 here in this last stage of the melt up. But whether it does or not, I think you could retest that $10 area in the bust. But then I expect the energy is going to be one of the big winners in the next cycle, along with other commodities. So I would not be surprised to see oil at $300 a barrel or higher.
How about uranium?
Uranium probably, is a winner too. I don't follow uranium, so I don't have any specific views on it. But I think oil and oil stocks will be big winners in the next cycle. Again, for all of this stuff, I just want to caution investors. It's getting from here to there. People hear things and they can lose track of what the timing is on things. You don't want to be betting on what's going to happen in 2022 and beyond today. It's like saying, hey, I can walk across the Grand Canyon from the South Peak to the North Peak. No, you can't. There's a trough in between. Trying to navigate from here to 2022, there's a huge trough in between. So just be careful. Don't straight line this thing, because there's some real problems between.
Fascinating. Very interesting. So let me ask you, just in conclusion, a couple quick rapid fire questions. And then I know you got to get going. So first question is that this deflationary bust that you see, positioning yourself in commodities, industrials, and PMs, either if you have a position before or you're getting one during the deflationary, it will set up to be, true or false, one of the best investment opportunities over the next decade?
I think for sure it will be among the leaders of the next decade.
Okay, then let me ask you, true or false, we will see more and more and more people that are waking up to what's the greatest Ponzi scheme in the world, and that in the short term could create some social unrest, but maybe we'll get a more optimistic outcome where more people wake up, and maybe we have the prospect of creating hopefully one day a better economic system. You think that's possible?
I'd say false to that one. I just think the seeds are sown. And I really don't want people thinking about what happens beyond. Really, we've got a huge event coming next year in terms of the bust, and then we've got a very dynamic, different kind of cycle after that, recovery cycle after that. If people get too far ahead of themselves and lose sleep over something that might happen in 2029, this is a forecast. I can be dead wrong. Other things can happen. My own view is the seeds are sown for, what I described. But, there's always surprises. There's always things that can change things. So
All right, David,
I
last
really want
question.
people not to get too caught up in the long, looking over really too big, first a down cycle and then an up cycle, and worrying about something 10 years out.
Understood. That's my mind. I just am so enamored about the future. Okay, so let me ask you two final questions. Quick. I didn't ask you, and I forgot. What happens to gold and silver if we have a deflationary bust? If, say, we get to 23 to 2,500 in gold and 35, 40 in silver before, what happens during it? Does it retest all the lows back down? Do you think at the coronavirus sell-off? Or where do you think it goes during a bust?
That's a great question. I up until probably 3, 4, 5 months ago, my belief was we were going to see gold retrace back to 1,000 or below in the bust. I thought it's going to hit all assets and hit the metals hard too, and silver back to single digits. But I wasn't at that time. I had silver going to 26, and I thought it could go back to single digits in the bust. In the last few months, I've changed my tune and my forecast. I believe gold probably doesn't get much below 1,800 again. So let's say we get to 23 or 2,400. I think the correction is back to that area. I think silver probably doesn't get much below the mid-20s again. If it goes to 35, 40, I think mid-20s is where you're probably going to want to step in again. And I think that is because, the Fed's set up to, as this thing starts to unwind, they're going to start printing money at a faster rate. They're already fast. Obviously, they've paused for a little bit, but it won't take them a mindset change to say, hey, we got to respond. So as they start printing money, initially, it's not, I call it right sizing. It's not just a matter of do you print money or don't you print money? It's, are you printing money for the large enough to offset what's coming at you, meaning an unwind that's of historic proportions. It will take them a while to realize that, hey, a couple trillion isn't enough, 5 trillion isn't enough, gee, we need 10. And so in that lag is when you get the real air pocket on the downside. But for metals, as they see a trillion coming at them and another trillion coming at them, they quickly look over the hump and say, hey, that's inflation at some point. And so that softens the blow for the metals, whereas the rest of the market keeps going down because, they're looking right in front of them at trouble.
Right. And we kind of did see that a little bit with the coronavirus sell-off when everything was going down, and then they kind of announced, and then we had like $100 day that kind of just popped up. So that makes sense. So let me ask you in final question, what's one thing in David Hunter's life that he's excited about or grateful for right now in life? I like to end that way with something you're excited about or grateful for in your life.
Sure. Well, I'm 68 years old, so my wife and I pretty much socially isolate. The one good thing is my daughter lives in town, and she's got 3 young boys, 7, 4, and 9 months, 10 months, I guess now. So we get to see them because they're pretty careful as well. That kind of gets me through the days that we're not, that I will tell people for sure. I love this business, and I love stock market, talking the market and the economy, et cetera. But, for young folks, for sure, your family and those kind of things are far more important.
Yeah, amen. Having our baby too. It's just like, it's definitely in 5 weeks, 6 weeks, it's already changed my life drastically. And that's why I want the property. And then you see how much shenanigans happen in the world. And it's like, just want to live a more peaceful, simple life. So you have a great time with your grandchildren, David. I truly appreciate you coming on and sharing your thoughts and helping people like me learn and consider some new things. So I appreciate it very much.
Okay. Thanks, Jake. Enjoyed it.
So if anybody, I know a lot of folks have heard of you, but if anybody hasn't, do you recommend, I know you're not you don't recommend stock picks, anything like that. But for people that want to understand your macro, is Twitter the best place, or do you recommend somebody go anywhere else?
Yeah, I would say follow me on Twitter. I do have a macro letter that I put out by subscription, so people can reach out to me through direct message on Twitter if they're interested. But I like to say to people, I forecast, I don't advise, so don't come to me for advice. Just if you want more of my forecasting, that's there. So
Cool. Thank you very much, David. I appreciate it.
okay, thanks, Jake.
Thanks, David.